If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Hello everybody, this is Tortoise Investing. Welcome to my Dividend channel. We talk about all things dividends. I do buy and hold forever videos on REITs, stocks, ETFs, and more. And today we're going to be taking a look at 3 dividend stocks that are down huge. I'm talking 30, 40, 50 plus %. We're going to pull them up in Qualtrim and do a deep dive into them, see what's going on. If you're new, please hit that subscribe button. I looked at the analytics. 70% of my viewers aren't subscribed. Go ahead and hit that button. Hit it. Do it. It's free, super easy to do. Let's march on to 1,000 subs. That would be awesome. Comment down below. What are you looking to buy this week? What are you looking at? What has caught your eye? And leave a like. Now, without further ado, the stocks we're going to be taking a look at: Dollar General Corporation, Target, and Crown Castle. Now, this is a REIT, and these are your big retailers. And as you can see here, year to date, Dollar General is down 53%. Absolutely huge. Let's take a look here at the 5-year and see when their last peak was. Let's see here. I think it was around here. $260 down to $115. Yeah, that's big. Adjusted free cash flow yield of just 0.11%. It's got a dividend yield above 2%. Now, that's something I thought I'd never see at Dollar General, is a 2% dividend yield. Payout ratio is 23%. Let's take a look at everything here annually. The revenue's increased over the last 10 years at a rate of 8.98%. Not too bad. Free cash flow, this is where they've ran into their issue. They're having a bad year, but besides that, it's pretty up and to the right. We'll take a look at the quarterly numbers too to see if, because sometimes Qualtrim doesn't completely update the 2023 numbers. EPS increased at a rate of 14% over the last 10 years. It's kind of like stalled out in the last 2 years. And their debt's $5.7 billion. Their EBITDA is $4 billion. That's not an issue. Personally, when I look at companies, I don't want them to carry more than 3 times their EBITDA in debt. And also, just quick disclaimer, no, this is financial advice. Don't buy these because I'm talking about them or telling you stuff about them. Always do your own research. Dividends increased at a rate of 15% over the last 5 years. Their last hike was 7%. So again, the reason I feel like that was the case, they're having a really rough year when it comes to their cash on hand, free cash flow. Their expenses are through the roof, and they are dealing with a lot of theft issues. Shares outstanding. They have been buying back shares at a rate of 3.83% over the last 10 years. Over the last 2 years, 4.87%. So they're buying back some of these cheaper shares, which I like to see. But I did read, as of right now, they have paused the share purchases, which I think is like the worst time to do so when your company's down this much. This is when you want to be gobbling those shares up. Like, when you're down 50%, you want to be buying them back here. You don't want to be buying them back, back through here in the 200s. But I let them do their thing. That's just personally what I would be doing. Return on capital employed in 2020, it was 12.5. Jumped up to 17.6 in 2021, 15.8 in 2022. And as you can see, it's just kind of a downward trend. 2023 is a 14.35. So let's take a look at the quarterly numbers here. Revenue still looks fine. They have reported the last quarter was positive free cash flow, but still not too pretty. Shares outstanding. It looks like they bought a little bit back between May and June. Not much going on there. They bought quite a few. They bought about 2 million shares back between February and May. So between February, let's see, they bought it between February and May. So pretty much in the 200s. I would have liked if they would have held off on that personally, but again, down huge, 53%. Bonkers, absolutely bonkers. It's going to take a lot for them to get back to what they were doing. If you take a look here at the 10-year chart, let's go ahead and pull up the price point. If you were to draw a linear line through here, like if you were to take it all the way back and you were just kind of just go up casually, they're honestly at the mean, like a little bit below it, but yeah, this run up is kind of what I feel hurt them. It got them overvalued, but Dollar General, again, always do your own research and stuff, but it is down 50-some%, and it is, I mean, it's a big name store. Next up, we got Target. Target is another one that's down off of its not 52 week, but off of its high, its last high. Let's see here. $264 as of November 15th, 2021. Now we're down to 123, so that one is also down. I think it's over 50%, if I did the math on that correctly, and I'm not dumb. Yeah, that's down over 50% as well, 18.9% year to date. Target's also dealing with a lot of like controversial media targeted issues. Adjusted free cash flow yield 2.51%, got a dividend yield of 3.53%, and a payout ratio of 59.3%. So not too bad there. Let's take a look at the revenue. Revenue's been increasing at a rate of 8.46% over the last 5 years. They do have a nice little pop here from 2020. Free cash flow, this is the thing that's hurting them most. They reported a negative quarter. We'll take a look at the quarterly for the free cash flow in just a second and see if we can't get a better idea what's going on there. EPS, again, kind of like with Dollar General, it was kind of going up and to the right. They had that boom last year and then right back down to earth. Debt's at $16 billion. Their EBITDA is at $6.6 billion. So even then, with the drop in EBITDA, that still is not more than 3 times their EBITDA in debt, so no problem there. My eyes, personally. Dividend. The dividend's been increasing at a rate of 9.8% over the last 10 years. Their last hike was like 1.8%. It was from $1.10 to $1.08 to $1.10. But they had these 2 massive hikes thrown in here from 68 cents to 90, from 90 to $1.08. And it's kind of like slowed down, but they've been increasing their dividend for a very long time. Shares outstanding have been decreasing at a rate of 3.5% over the last 10 years. 5.6% in the last year. Very nice. Like them to be buying these shares when they're down. Return on capital employed, 15, 16.4, 21, 27.9, and this year 11.37. So again, falling back down to earth. Let's take a look at the quarterly. Let's see here. So they are positive when it comes to their free cash flow for the year. Last year they had $5 billion. This year they reported $2.2 billion and a negative $340 million quarter. So right now they're sitting at about $2.5 billion in free cash flow for the year. So I'd like them to jump back onto the buying shares back. I think that would be such a great idea. EPS is right in line. They had that drop July around last year, but things are not going terribly for them. Let's see here. The debt's $14.9 billion. Let's see. If you look at that. Let's see. Oh, we already took a look at that. What am I doing? Shares outstanding. Yep, looks like they were buying them back, and then things kind of tapered off around October 29th. So around October 29th, looks like they pretty much have stopped buying back shares. When was that? October 29th, a year ago. So around here-ish is when they stopped buying back shares. So with that free cash flow on hand, I think it would be a great idea if Target was to just jump back in and start gobbling up those shares, even if it impacts how big of a dividend hike you can do next year. Only increase another 2 cents. Use that free cash flow and stuff to buy back these cheap shares. Like, it'd be such a great idea. Lastly, Crown Castle. Let's take a look at its high of $207 January 3rd, 2022. And it's down to 98, another over 50% drop. Just a free cash flow yield of 3.89%, dividend yield of 6.36%. And when it comes to REITs, you don't look at the payout ratio, you got to look at the funds from operations. Revenue's been increasing at a rate of 11% over the last 10 years. Free cash flow has been increasing at a rate of 16.82% over the last 10 years. The debt is $20.5 billion. REITs usually carry a lot of debt, so I'm not going to pay that too much mind. Dividend's been increasing at a rate of 8.31% over the last 10 years. Crown Castle, I like them a lot. I know a lot of people prefer American Tower, but American Tower's got a lot of international exposure, and their financial sheet and their balance sheet doesn't look as good as Crown Castle's does. Crown Castle's got a lot more cash on hand. They got a lot more free cash flow coming in, and they're all in the States, I'm pretty certain. More than 40,000 cell phone tower REITs across every major U.S. market. Yeah, so I'm pretty sure they're all within the United States. American Tower, you got in all different like countries and stuff. So I like that about them. Again, a lot of REITs are just beat to death right now because of the interest rates. And there's a Fed meeting coming up. Is he going to increase them again? Is he going to pause? What's he going to do? What's he going to say? A lot's riding on this week. But yeah, guys, just want to take a little bit of a deep dive there into 3 stocks that are down 50% from their highs. And it's just a lot going on. A lot going on in the market in general. I hope you enjoy that. As always, make sure to hit that like and subscribe button for more. And until next time, see you.